That, together with the depreciation of the rupee, is going to put pressure on input prices. And if oil prices are not adjusted, that's going to put pressure on fiscal deficit. Then there is also concern about further easing around the world by advanced economies. Should that happen, again, we will see the impact of that possibly in terms of liquidity flowing into commodities and whether that puts upward pressure on commodity prices. That's always been a debatable issue, what impact easing has, liquidity easing by advanced economy central banks has on commodity prices, not only here in our country but around the world too. So it's not clear, but a lot of learned people say that there is evidence that some of that liquidity will find its way into speculation, and that might put pressure on commodity prices. And then there is suppressed inflation. So these are all the risk factors to inflation. And finally on this, I want to say that what we've said in the June statement, what I said at the speech on the Statistics Day on the 6th, and today we've said again, which is that the interest rate is not the only cost or only inhibiting factor that's affecting investment. There are other factors unrelated to the monetary policy. In fact, estimates show that the real interest rate today continues to be lower than what it was in pre-crisis period. The second thing is about why did we reduce the SLR? Yes, liquidity is comfortable. Indeed, it's become within the plus minus 1% NDTL range. Yesterday, I think it was 490 billion rupees. Also, excuse me, also SLR is at aggregate SLR is at 28 to 29%, above the minimum required. But some banks are short. So what it does, what SLR does, is that it gives liquidity to those banks which want it, like CRR, which is across the board. And I've heard all of you interviewing the bank chairman, and they telling you that this will have a positive impact on liquidity and indeed on their lending, especially to the retail sector. So you heard from them. I don't have to support that anymore. Also, another consideration that weighed with us was that reducing the SLR was consistent with the long-term objective of bringing that down. So those are the factors that gave the logic for our action. In addition, I'll just take a couple of minutes more. We had a meeting with bank chairman today. We discussed 4 topics. The first one was the new guidelines for the priority sector based on the NAIR committee recommendations. That went through, before we took the final decision, we had extensive consultations with all stakeholders, including bank chairman. Evidently, there are still some open issues. One, I've listed only a few of them. One of the things that bank chairman said was that you are begging loans for direct agriculture at 13.5%. Does the direct agriculture sector have the absorptive capacity for that sort of credit? Foreign banks had the predictable problem of adjusting to that. And one of the foreign bank chairmen also said quite thoughtfully is that, look, having 20 branches becomes a sudden threshold, because once you come from 20 to 21, you inherit all these costs. So does the cost-benefit calculus still hold in terms of priority sector? And there was some concern about the interest, not concern, but some lack of clarity on interest rate ceiling for lending through intermediaries to be reckoned as priority sector. I thought that some of these suggestions were quite reasonable, and what we decided was that in the next 15 days there will be a meeting at the operational level, followed by a meeting at the bank chairman level with the deputy governor in the next 1 month. It's not clear what we will change, but certainly we have an open mind. The second topic that we discussed was the reasons for recent slowdown in deposits growth. the wedge between credit growth and deposits growth. Subir explained that how over the last 2 years it's moved in opposite directions and how we are unable to get a very clear understanding of the dynamics of this. One issue that came up was whether retail depositors are actually influenced by the real rate of interest. And the logic and understanding is that they'll weigh that against the inflation and say, am I getting a real rate of interest or should I shift to some other alternative? But some of the experienced bank chairmen said, no, that doesn't happen. Retail depositors are somehow hostage either to banks or to the small saving instruments, and therefore, they're not that cost sensitive. Mr. Chakravarti, who is an experienced banker, disputes that, but you will hear him dispute that in front of you. Okay, I don't want to preempt that. But what we did tell bank chairmen is that they must interact more closely and more often with depositors associations. I asked them actually how many of them have had a meeting with depositors association at the sub-state capital level, at the level below the state capital. At least half of them raised their hands. So I would think that that's happening, but we did say that they must have interaction at that level. The third issue was about floating rate-based deposits, and Anand Sinha explained this, saying that this might be necessary and important and appropriate for the banks to manage their balance sheets and for the Reserve Bank to get better monetary policy transmission. But the single message we got was that our retail depositors are not yet informed enough, literate enough to take on something like this, and that even the current facility allows them to hedge against inflation. Therefore, that as this idea of floating rate deposits has to be floating for some more time, it cannot be a reality in the short term. The final issue is about capital flows, attracting capital flows, and this discussion went along predictable lines. There was nothing really new that we got, except saying that at 6.5% India is still better than 90% of the planet, but that still is not good enough for us. So it's managing the current account deficit and financing the current account deficit remain big concerns now. Okay, thank you very much.
Should we, for a change, start with print media? Parnika?
Governor, this is Parnika from Business Standard. So my question is that has RBI raised the bar for future rate cuts given the revisions in inflation and growth projections and also the policy initiatives that are expected from the government?
No, I don't think you can say it exactly in that phrase that we raised the bar. Our stand has been consistent in April, in June, today, indeed over the last several years, which is that monetary policy and fiscal policy have to run in coordination, and that monetary policy action alone will not deliver the macroeconomic stimulus that we want. There are certain things that need to be done. That's why we use that phrase, multiple obstacles to growth. As those are resolved, we will adjust our monetary policy stance. But I don't think you can say that the bar has been raised in this policy. Subir, is that okay?
Sir, you have increased the inflation forecast itself to 7%. So, per se, do you see at all a scope for cutting rates? Because when it was 6.5 in April, you said you see very limited room for further cuts. Now that you have raised the rates, even with the way in which you have projected inflation and the very strong reasons you have given to fear it will rise, do you see a scope for cutting rates at all, at least in this calendar year?
Well, I see a scope, okay, but I cannot really say when, and I cannot even say when it might happen. But you're right that the fact that inflation projection has been raised gives room for accommodating or adjusting to that sort of inflation. I don't know if that's the right word, but given that that's the projection. But you also have to see that against the growth that I explained just now. The output gap is quite small. Indeed, it could be smaller than we had projected if the trend growth rate is lower than 7.5%. So it won't go entirely by the inflation projection. It will go by a number of figures as well as how the risk factors might unfold.
Similar line of thinking, Governor, sorry, but there's rightly or wrongly been a sort of understanding in the market that if the government acts on the fiscal side, there will be room that will open up for monetary action. But under the current economic scenario, just growth and inflation, do you see that not being the premise that we should be working on? Because inflation is still well ahead of your targets, and you're talking about upside risks on inflation as well, which are, aside from the fiscal risks that have underpinned inflation.
No, is your question that...
My question is that will fiscal action simply be enough to spur monetary action or no? Because the current inflation scenario has gone beyond that.
I wouldn't feel comfortable answering such a specific question about the fiscal action would trigger monetary policy action. There are a number of things that need to be done to revive growth sentiment, to spur investment, both domestic and external. Some tangible, credible action on fiscal deficit certainly would revive investment sentiment, but there are other things to be done as well. So to say that, look, that is necessary or sufficient for a monetary policy response, I don't think the Reserve Bank will feel comfortable answering a specific question like that.
So this is Shamik.
No, I would say that you cannot characterize that as necessary or sufficient. How we will evaluate that as being necessary or sufficient, or both, will depend on other circumstances as well.
Ritesh.
Governor, Ritesh here from Z Business. Governor, you have mentioned in your past policies, that today also you mentioned about that inflation being your primary objective at this primary issue at this point in time. But given the way you have actually, reduced the growth targets and the macroeconomic scenario looking like, plus the external scenario,
Okay, very quickly, just before we start wrapping up the markets, quick calls, closing strategies. Ashwini, any stock that you would take a BTST on?
Well, ONGC seems to be breaking out, and it's had a 5% move. So this is a buy with a stop about 284 and look for targets about 305.
Mitesh, what about you?
Yes, I look at a DLF. I think Ashwini also mentioned the stock as a BTST also it can be taken. I think I've been waiting for the stock to trade about 215, 217 levels. But for the timing as a short-term trader, I think, keeping that as a target, I would suggest buying this with a stop at just below 205.
All right, let's start winding up the market today. It's been an eventful day. There's no taking away from that. 52.30 on the index, so we've held steady about 6.6% higher. DLF, the rate sensitives are the ones which are in focus. DLF topping the charts there, 3.5% up. Tata Motors, HDFC. Also, some of the key banking names have supported the market move, and Axis Bank has also moved in this session. Aside of that, of course, in ACC and ONGC, Reliance Industries, the oil and gas space has been active in today's session. Some of the pharmaceutical names in Cipla post earnings 1% up on that counter in trade. On the losing side, the key losers in trade this afternoon, Bharti Airtel down about 2.5%, Hero MotoCorp, BPCL, State Bank of India, Jindal Steel and Power and M&M have lost ground in trade.
Okay, on the broader end of the market, pull up a couple of stocks which came out with numbers. Dishman Pharma, 10.5% higher post the numbers, doing very well. SR Oil ending at the highest point of the day, good going for that one. There is strength in TTK Prestige and Manappuram Finance, so they have done okay for themselves. What has been weak is the Titan Industries post the numbers. 222 or 223 is where that one is trading, 221.80. I believe there could be probably more downside ahead because of the management commentary, but you never know. Watch out though for Titan. A couple of downgrades have already come in, or a couple of suspect reports have already come in on Titan. That aside, the other result, boys, Petronet LNG should come up on your screen. Again, just about estimates, but flat in trade is Petronet LNG. Yesterday, the stock of the last half an hour, Shree Cement, wherein there's a lot of talk about additional penalty levied by the CCI, but up 3.5%. Mind you, the volumes are so thin on Shree Cement that you really can't take a proper call on that one. Tata Global Beverages up 3.5%. India Cements up 3.5%. So good going for a couple of these as well. On the flip side, I spoke about Titan, so that is of course there. That aside, a couple of other stocks which have looked weak in trade. Okay, we'll talk about that.